Welcome to Trading Nation. I'm Seema Modi. One of Wall Street's top strategists is warning clients about a great divide in the market. It comes as a surprise increase in weekly jobless claims, certainly rattling investor sentiment today. It's Amanda Agati, Chief Investment Strategist at PNC Financial, who's joining us on the phone. Trading Nation, it's good to have you on today. Amanda, how do you think Wall Street is hurting Main Street right now?
Well, thank you for having me. We think there's a big disconnect between the haves and the have-nots as it relates to Wall Street and certainly Main Street. And I think a really interesting kind of comparison of that is looking at the NASDAQ 100 relative to small cap value. It's effectively, in our view, the stay-at-home trade as the NASDAQ 100 and the go-outside trade as small cap value. You've seen this massive performance divergence or differential. The differential between the two is actually at its widest level since 2000. And so we've seen a lot of comparisons talking about the dot-com era and a bubble there as it relates to the NASDAQ 100. But in our view, those comparisons are not warranted at all. We actually feel relatively positive on the positioning in the NASDAQ 100 and much more concerned about the underlying health or lack thereof with small cap value as a proxy for Main Street.
So I find this chart so interesting. Can you explain to us why we're seeing this growing divergence between the NASDAQ 100 and the small cap index and why it's important to watch?
Well, I think you have to look below just price action. So again, a lot of the talk lately has been the NASDAQ 100 hitting all-time high absolute price levels. But especially in this kind of an environment, you've got to look under the hood. If you just look at things from a forward P perspective, small cap value was at an all-time high, if you can believe it, just in the last couple of weeks. And yet the QQQ as a proxy for the NASDAQ 100 is barely half of its valuation level of what it was back in the dot-com era. And so when you look at it from a growth perspective, which we're in a very growth-starved world, when you incorporate growth, it makes the Qs look even more attractive on a relative basis. The PE to growth story for small cap value is in excess of 3 times, whereas the Qs are almost half that. So a very compelling kind of trade there. And then when you look at leverage as well, again, reinforcing kind of the strain that we're seeing show up in Main Street America here, net leverage ratios for small cap value are 9 times the leverage ratios of the Qs. So really night and day in terms of a comparison with what happened back in the 2000 or dot-com era. Small cap was not anywhere near as overburdened by debt back then as it is today. And so we think the winners are going to keep on winning. The NASDAQ 100 really shares a set of common, really attractive characteristics: secular revenue growth drivers, strong profitability metrics, and they're throwing off a ton of free cash. And if you can believe it, in this crazy upside down world, the NASDAQ 100 is actually paying a higher yield than the 10-year Treasury. So we really do think that the strength we've seen lately is justifiable. And although maybe the significant outperformance going forward may slow down a bit, that torrid pace might slow, we definitely think that the path forward is likely to be led by the Qs.
So if that's the case, what worries you most about the market right now? I see that you see tech continuing to outperform, but if that's the case, what gives you the biggest pause when you evaluate the market, valuation, geopolitics, the COVID case count that's still on the rise in this country? What gives you the biggest pause?
Well, the market as a whole is certainly not cheap, right? So you just look at the S&P 500 is trading at a forward PE of somewhere in the neighborhood of 22 times. So the market is effectively pricing for perfection, but for all the reasons you rattled off, the backdrop is really anything but that. I think at the end of the day, the biggest concern for us, but also potentially the biggest opportunity for the market, is COVID itself, the path forward of the virus, and the path forward or progress on reopening plans. And, we think the market is going to chop around for a while as it continues to try and digest the path forward on the virus, with something like 75% of states now pausing or reversing some form of their reopening plans. I think it's really hard to justify a perfectly V-shaped economic recovery. And so we've been saying right along here that the market recovery is a different shape than the underlying economy. It's not even a letter of the alphabet. It's a square root shape. That is, we've had a sharp downdraft. We've had this huge rally, and now we're going to be range bound for a while until we get some really significant positive data. Bouncing off historic lows is not justifiable to keep this market going. We really need to start to see fundamental strength in earnings growth, and we haven't seen it yet, even though it's a couple weeks into earnings season.
Yeah, still early on, but I hear you. Amanda, thanks for joining us today, and thank you all for watching Trading Nation. I'm Seema Modi. We'll see you next time.